Welcome to the podcast on the changing landscape of transfer pricing. In this podcast, we aim to discuss some of the prominent ongoing topics in transfer pricing arena. I am Nupur and I have with me Sachin, an expert in transfer pricing with over 20 years of experience. Sachin, welcome to the podcast, and it's very good to hear your insight on various ongoing transfer pricing topics. The first question revolves around operational transfer pricing. We have been seeing growing trend in the direction of operational transfer pricing. How can organization effectively manage and implement operational transfer pricing to optimize the global operations? What are some common challenges faced by companies when implementing and managing operational transfer pricing? What are your thoughts on this question, Sachin?
Thank you, Nupur, for having me. Operational transfer pricing is a form of, in a sense, implementing, as it were, the transfer pricing manual or the transfer pricing policies across the length and breadth of the enterprise. And we speak of enterprise as really being the group itself. So the group comprises of a number of entities, and these entities have transactions with third parties that, for instance, may be suppliers, that may be customers, and they have interactions with one another, and these interactions are referred to as being intra-group transactions. The goal of operational transfer pricing is to get ahead of the curve and implement the policies in a actionable manner, which is to say that if, for instance, a organization is operating by way of a contract manufacturing arrangement, therefore supplying components that are manufactured to a principal entity, then the contract manufacturer will, for each SKU, be able to determine the cost and the related profit margin that is determined through a benchmarking analysis and is applied at such SKU level and at a unit level for the purpose of invoicing to the principal company. And this is undertaken at the level of each transaction, including periodic true down adjustments in order to achieve the desired arm's length result on an ongoing basis, which may be typically every month or every quarter. What this does is that it eliminates the need for year-end adjustments that could tend to be quite significant in the context of goods in particular, or even in the context of services that do not operate necessarily on a full cost plus basis. In respect of goods, one could envisage situations where a consistent under recovery of profit margins relative to the arm's length price could result in having to significantly invoice at the end of the period without a corresponding supply of goods by the contract manufacturer. And as a result, from the importing principal's point of view, it could result in a payout which would not be backed, in a sense, by a corresponding purchase, because it simply represents a true-up adjustment. What operational transfer pricing does, therefore, is to make sure that the policies are acted upon in letter and spirit, and transactions such as purchases manufactures, services, and financing are in sync with the contemplated transfer pricing policy of the company, that of course has a benchmarking analysis to support it at the back end. In a respect of transactions such as the payment of royalty or the payment of interest, normally operational transfer pricing tends to be easier. However, it gets more complicated in the context of any forms of manufacturing and distribution, where products are having to be dealt with at a unit level. However, in the case of interest also, given the currency volatility, because of the fact that most intercompany financing takes place in different currencies, and the rates of interest, especially the variable context, could vary, and add to that, for instance, the complexity arising out of the transition from LIBOR to a more globally accepted IBOR, for instance, could result in frequent changes to the interest rate that would have to be captured through the operational transfer pricing system. What's important to recognize is that operational transfer pricing is fundamentally a interplay with not just the transfer pricing policies, but it rides off of the accounting system of the group. And to this end, it runs on a platform, and that platform could be anything such as an Anaplan platform, or it could be a Hyperion platform. But it tends to run off of a platform that enables the ability to extract data from the existing ERP system, which essentially has the financials of the company, and then project out the expected transaction that is contemplated to take place, and then determine the pricing of such transaction as a consequence of the current financial state at a unit level and the projected transaction that is to take place to arrive at such price as will be in sync with the transfer pricing policy and the arm's length principles. I hope this was a sort of a elaborate roundup of what operational transfer pricing is and what factors need to be considered, because I think what is also relevant to note is that operational transfer pricing also touches customs, especially in the context of having to deal with the fact that it results in the repricing of goods in particular on an ongoing basis, again to be consistent with the transfer pricing benchmarks.
Thank you. Indeed, that was a very comprehensive overview. I would agree that it helps in increasing efficiency and abiding by policy in the more effective manner. But many companies do face challenge of analyzing the cost benefit in terms of operational transfer pricing implementation. Would you have some comments regarding it?
Operational transfer pricing, in a sense, takes us several steps forward from documentation and policies and agreements at a conceptual level. So if we think of the so-called transfer pricing value chain, as it were, at the outset, we have been used to dealing with transfer pricing regulations that stress the importance of documentation of intercompany agreements, and these are regarded as being hygiene factors. Thereafter, there is the element of compliance, which companies have over the last 2 decades become much more accustomed to maintaining, and this has been augmented by the three-tier documentation. Operational transfer pricing is a process of demonstrating the or actioning the documentation in the manner that it reflects the conduct over contract type of approach. And therefore, because it is transactional and it goes well beyond principles of year-end financial analysis to a state of current and here and now type of transactional behavior, the level of investment in technology is significantly higher than would be called for in respect of documentation, which typically is based off of databases. And therefore, the need for investment at the outset in technologies that overlay SAP and Oracle as ERPs, which I just explained, where our platforms such as Anaplan, there are others as well, which could serve to deal with the extraction of data and the validation of the projected transactions. So the challenges are typically front-ended, which means that you first have to invest in design and implementation of the transfer pricing policy, and thereafter there is more operationalization or the running, as it were, of the platform on which the OTP function runs, which tends to be less of architecture and more of maintenance. So therefore, it's heavily the more you plan and the more you design and the more attention you pay at the beginning to things like the charts of accounts and the methods and the transactional differences and how they have to be addressed, which are also typically documented in the transfer pricing manual. There's that much less maintenance in respect of ongoing transactions for OTP.
Yeah, that was very helpful, and I would agree with what you have said. Coming to services play a vital role in multinational corporation. How should companies approach transfer pricing for intergroup service, ensuring they accurately capture the value and prevent any potential tax dispute?
Nupur, the fact is that, as you've also appreciated, there are a host of controversies around services, the most significant of them being based on the fact that services are, in a sense, incomprehensible, because of their intangible nature, but also unlike intangibles that, in a sense, gives rise to something of value that has some form of a capital nature or a capital value. The service is more ephemeral or transient and therefore can tend to be more easily disputed than other forms of either intangibles or tangibles. And therefore, the services have tended to be much more susceptible to audit risks. The proposal from the HMRC to maintain an audit trail at a transaction level is perhaps a useful start for services, because the key to services is to try and establish the provision of the service, in other words, the rendition of the service. And at a different level, there has been also some degree of focus on the benefits arising from the service, although often enough that is not necessarily a requirement. What is important, however, is to demonstrate that a service is provided and that service is not either duplicative or is not incidental or is not ancillary or is not of a shareholder nature. And sometimes the very tenuous arguments arise out of whether that service is auxiliary or is, let's say, integral to the company or the associated enterprise to have to pay for. And for example, one of the very problematic types of service arrangements arises from on-call services, which is to say that there is a pool of people who is deployed, and this pool of people is effectively paid by an associated enterprise to remain on call. And it may happen that this pool of people is either utilized 130% or is utilized 70%. And the answers could be very different. And that again could result in questions being raised around the rendition of service and possibly the nature of that service as to whether it falls into the definition of auxiliary or is an integral service. It is here that safe harbor for services do play a important role, because they tend to at least give the taxpayer a degree of benefit of doubt insofar as services are concerned. But again, safe harbors have their own thresholds in terms of both markup as well as quantum for low value services. And so by definition, services do tend to be having more difficulties, particularly from the payer side. But I wouldn't say that services are also free from the rendition side, because if you think of the large GICs that are in India, the large GICs in India also render services to their group companies on an ongoing basis. And the markups that are one experiences in India for the provision of such services, they may be technology services, they might be design services, tends to get questioned on the other counterparty side, even though it may be justified from an Indian standpoint, simply because the Indian markups tend to be significantly higher than one experiences in other quarters of the world. But when we speak of management services, which are typically the ones that tend to get questioned the most, because even for design and engineering services, one does tend to see more evidence. However, when it concerns marketing services or it concerns strategic services, these are often services where it is not easy to create evidence on an ongoing basis, because much of this happens as we are speaking over a Zoom call. And therefore, while digitization in some sense would enable the effort and their payback also from an evidence point of view, these calls do happen to be highly sensitive and very confidential. And therefore, how much needs to be disclosed is also open to question. APAs in that sense happen to be good tools to deal with.
Like you mentioned regarding audit trail, I even think that having audit trail and having proper documentation supporting the pricing and regular reviews of the markups are very helpful in this direction.
I couldn't agree more, yeah. And therefore companies do have to invest more than they would on other transactions in respect of keeping hygiene for service transactions.
Yeah. Moving to the next question around financing. Transfer pricing in relation to financing transactions can be quite complex. How can companies ensure compliance and mitigate the risk associated with intercompany loans, guarantees, or other financial arrangements?
Intercompany financing arrangements have in recent years, in addition to, of course, being under the scrutiny of authorities in countries such as Australia, Canada, the United States, and of course India as well. And this is because while interest rates are one matter, because it's a matter of which currency and which corresponding interest rate is to be applied. But the number of variables that apply in a financing transaction are many. You have to deal with as we said, you have to deal with currency. You have to deal with the timing of the transaction and the prevailing base rate. Then you have to deal with specific factors that prompt the transaction, such as the credit rating of the borrower, such as the uh, circumstances in which the transaction is carried out. So, for instance, if you think of a guarantee, would the borrower have been able to obtain the funds in the first place without a guarantee? Because it is contingent on that one may decide to apply the relevant method. When it concerns arrangements such as loans, one also has to take into consideration three or four variables. There is the aspect of what is the arm's length rate for the loan, which represents interest. Then there is the aspect of whether that loan is what would have been a instrument and that would have been adopted between unrelated parties, or whether it would have been, instead of a loan, an equity that would have been resorted to. So we are speaking of the arm's length character of the transaction itself and its potential reclassification. And then the third element that comes into play is the aspect of interest limitation rules, which are not necessarily a transfer pricing construct but emanate from BEPS Section 4. So, in short, the aspect of interest on loans, or for that matter, the payment of fees for guarantees, are a fairly vexed matter because of the subjectivity involved and the difficulty in obtaining exact comparable uncontrolled rates. Although admittedly there is enough evidence to demonstrate the rates at which transactions happen at the base rate level. So base rate are not typically a matter of significant difficulty, but the premium attached to the over the base rate, which is contingent on the credit rating of the entity that is the borrower, and to note that the credit rating of the borrower may be at variance from the credit rating of the lender because of the risk profile of the borrower relative to, let's say, the group, could change the credit rating of the entity that is the borrower, and therefore increase potentially the interest rate due to the spread having to be increased owing to the risk profile. When it concerns arrangements such as cash pooling, that's a whole different kettle of fish because it's also dependent on exchange control regulations, that whether they permit cash pooling arrangements to take place, given that they entail a remittance outside the country. And then there are certain times when insurances also or reinsurances also have certain regulatory safeguards attached to these transactions. So without getting into cash pooling or interest or insurance, suffice to say that the elements of loans and guarantees by themselves present scope for considerable controversy, and therefore the guidance that has come through from the OECD around either concerning risk-free rates of return or risk-weighted rates of return, while being helpful, are highly qualitative and therefore would result in much debate with respect to the revenue authorities, given that there is guidance, but at the same time its application could be interpreted very differently.
Yeah, completely agree. Also, the rules surrounding thin capitalization varies, or the interest limitation varies so widely across jurisdiction. That could be another thing to keep in mind And regarding the safeguards one can take could be proper documentation around determination of terms and conditions, specifically mentioning in detail the repayment schedule. These things can help.
Precisely, and also what happens in the event of a foreclosure, what happens in the in the event of a moratorium, what happens in the event of a transaction having uh, a zero coupon bond. These are all again questions that could result in fairly different internal rates of return.
Thank you, Suchin, for providing such valuable insight. And thank you all.